Multiple time frame analysis. In this video, you will learn what is multiple time frame analysis, how to use it to build a picture of the market, how to use it for reducing risk in a trending market, how to use it to avoid low probability trades, how to use it to find high probability trades, how to use it to reduce risk when counter-trend trading. Multiple time frame analysis involves observing different time frame charts of the same asset to see which way we should be trading. By identifying what the majority of traders are doing on the higher time frames, we can then use the smaller time frames to minimize risk when entering trades. It is recommended that you view time frames that are at least 4 time periods apart: daily, 4 hour, 1 hour, 15 minutes. We can use this approach for counter-trend or trend trading. We can use different time frames like pieces of a puzzle to build a picture of what the markets look like as a whole. What is the larger time frame telling us? Are we in a trending or ranging environment? Once we know the direction we want to be trading in by looking at the bigger picture, we can then look for lower risk trades on the smaller time frames. Multiple time frame analysis works because it helps us align our trades with the bigger picture. By observing the direction of the trend on a higher time frame and then waiting for the lower time frame to be in alignment before looking for trades, we increase the probability of a winning trade as well as reduce the size of the initial stop loss. In this example, we have a daily and 1 hour chart both in an uptrend. Therefore, we only want to be looking for buying opportunities. Instead of entering a trade on a daily chart with a large stop loss, we can enter a trade on the 1 hour chart using a smaller stop loss, which enables us to reduce our initial risk. In this example, the daily chart is in an uptrend, but the 1 hour chart is in a downtrend. This is a riskier trade as the 2 time frames are not in alignment. It would be best to be patient and wait for the 1 hour trend to align with the daily trend before looking for a trade setup. You can now see that the 1 hour trend has turned back up and is now in alignment with the daily trend, offering higher probability trading opportunities. The highlighted area is a zone where looking to buy can provide high returns. Using multiple time frame analysis can be used when looking to counter-trend trade. When price hits a key support or resistance level on a higher time frame, for example a daily chart, it is very likely that price will stop because there are large traders observing those key levels, including banks and financial institutions that trade billions of dollars. In this example, price is trading in a range on the daily chart and we have identified a key resistance level. When price hits the resistance level, the market is likely to react once again. Trading directly off a daily chart using candle patterns would require a large stop loss because the candles are very large. However, when the daily resistance level is hit, we can look for low-risk trading opportunities on the smaller time frames, like the 15-minute chart because the 15-minute candles are much smaller. Here we see the same daily resistance level on a 15-minute chart. You could look for selling opportunities when you see a candle pattern forming. This can lead to a profitable trade with low-risk exposure because the stop loss would go above the 15-minute candle and would be much smaller on the 15-minute chart than on the daily chart. Therefore, using multiple time frame analysis, you get the benefits of strong support and resistance levels on the higher time frames and lower risk entries on the lower time frames. So far, you have learned that multiple time frame analysis can help reduce the risk on your trades. Higher time frames can be used to ascertain the overall market environment. Lower time frames can be used to fine-tune entries. You should use 2 time frames at least 4 time periods apart. And that multiple time frame analysis can be used for both counter-trend trading and trend trading.